Hi, Allison.
Hello, nice to see you.
Nice to see you again. Uh, Today, from our tax dialogue to global MBA tax management and compliance, it's a, it's a great honor for us to talk with Allison Christian, who is a Heward Stigman Chair in Tax Law in McGill University, associate professor in University of Wisconsin previously, associate in Watchell, Lipton, Rosen. Allison has a tremendous and gorgeous curriculum life in tax, and it's a very good reference from Canadian perspective. So Allison too is our professor in our global MBA in Facultad Brasileira de Educação. So Allison, about the taxation in digital economy, what is your perspective from Canadian focus about the new law that Canadian government is implementing?
Well, thank you, first of all, for having me. It's great to be here and just be speaking with you about digital taxes and about taxes in general. As you know, I think all tax is fun to talk about. So the Canadian government announced some time ago that it had plans for some sort of digital services tax without much detail. And then they issued a budget earlier this year in which they laid it out that there was a plan to have a 3% digital services tax, much like the one of France. So it's just a gross basis excise tax on certain digital companies that exceed the threshold being 750,000 euro. I know that's weird that the threshold is in euro, but we're following the European standard for that. And they say that it will go into effect in 2022. So we're going a little slow. You know that France already has theirs kind of up and running, and the UK has theirs, and Canada's a little bit behind them. But I think has plans, if things don't work out at the OECD, to get a global consensus that we will put our digital services tax in place.
So the nature of this tax of the digital economy is equal to VAT, or is an income tax?
Yeah, that's a very good question. It's a little bit strange to know what exactly is this kind of tax. So in the same budget, Canada also announced that it would extend its withholding requirements for the Canadian goods and services tax, which is our VAT. So you have two kinds of tax. You have this extension of withholding to non-resident companies that are selling goods and services to Canadians. And then you have also this other standalone thing called a digital services tax, which is mainly focused on digital services providers, but they're pretty clear. They're trying to get at, you know, your Airbnb, Netflix, Google, Facebook, kind of all across. Those same companies, some of them will also be subject to this extended withholding. But they're two different kinds of taxes. So it's kind of worth thinking about that. The goods and services tax is supposed to be charged on anyone who is a registered registrant, somebody who is obligated to withhold. And that's somebody that has $30,000 Canadian in sales of goods and services to Canadians. So you would think that would apply to the whole world, no matter where you were. But of course, it doesn't traditionally. If you were non-resident, you just were not caught in that net. And a long time ago, Quebec had changed this. They had already started talking about a Netflix tax or an Airbnb tax, where they were going to bring those companies into the withholding regime. So Canada, again, as a federation, as a federal system, did not have a national extension of their withholding to foreign companies, but now they do, and that's logical. That just makes sense. You can't have non-resident companies not collecting withholding and resident companies collecting withholding, because the competition between those kind of firms is too great. But the digital services tax is different, because it's whether you are providing a taxable good or service or not. So Facebook is not actually providing a taxable service in the sense that no one's paying anything for it. But the digital services tax would theoretically hit Facebook to the extent that it's possible to figure out what percentage of Facebook's advertising sales can be in some way connected to Canadian users of the platform.
Yeah, this topic is very important, because for double TT, or double tax income taxation, if we apply the 7 provision, the business profits, the company, online, digital, must pay in resident, except that they have a permanent establishment.
Right.
And if we share the idea, the tax nature of this tax is an income tax, so we must apply the 7 provision and not pay in source. But if it's not, obviously Canada pay tax on digital with this 3% of the total transaction. I'm in the correct way, or I'm wrong?
No, I mean, I think so. You have these yet another tax. So the permanent establishment is in the income tax, and yeah, you can avoid Canadian income tax on corporate profits if you don't have a physical presence in Canada, much the way you can in other countries. And what the digital services tax is doing is saying, even if you have no physical presence and you're not subject to our income tax, we are still going to subject you to this additional excise tax. Now, look, the French DST is the model, and you can sort of look at what they're trying to get at, right? What are they counting in this excise tax? It sort of looks like advertising revenues, if they charge a fee for platform use, but not necessarily, for example, would it be the sales that you would have through your service? So if you just think about Amazon, the French DST would not apply to the goods and services that someone is buying on Amazon, and neither would the Canadian, presumably. But the VAT would, and the Canadian goods and services tax would. So if Amazon, for some in some sense, doesn't have a physical presence here, I think they actually do in Canada in some ways, but they might have lines of businesses that have a PE and lines that don't. So if we just sort of think about Amazon's business model, you don't pay to use the Amazon service, so there's no goods and services tax there. But when you buy goods and services from Amazon, you would think that Amazon ought to withhold the goods and services tax that you would pay if you bought the exact same good or service from another vendor located in Canada. So that's one part of the Canadian budget, is to make sure that Amazon is charging GST the same way that its Canadian competitors would. The Canadian competitors that have, for example, a bricks and mortar alternative, like Canadian Tire or even Walmart Canada, right? They're collecting GST, so Amazon will have to. But Amazon's own profits aren't subject to Canadian tax unless it has a permanent establishment to which some of its profits are attributed. So without that PE, providing services to Canadians directly, for example, with the Amazon World Service, like coding or, different kinds of online products, offering those to Canadians may be producing some income from Amazon. If they don't have a PE, they're not subject to the income tax. And if they're not selling a good and service, they're not subject to the GST, but they might still face that digital service tax if their profits are high enough in Canada.
I remember when France talked globally the possibility to create the GAFA law, this is the Google, Apple, Facebook tax. Trump President Trump said that the United States increased their taxes against France.
Yeah.
Something similar happened between Canada and United States because.
Well, yeah, not yet. What were you going to say? Because
I talked previously with David Rosenblum today in another interview, similar with you, and he said me that the United States never signed MLI and never create a digital tax service.
Right.
What do you think of that? I think because United States and China are the biggest players around the world, so they are trying to the market maker be happy without taxes.
Well, I think we should be careful because the United States is also a federation of states, and the states are introducing digital services taxes. So I'm not quite sure what Professor Rosenblum means. He means there's not going to be a federal digital services tax, but there's already a number of U.S. states that are introducing them. And indeed, there's precedent for the expansion of withholding to non-resident companies in the Wayfair decision, which is a U.S. tax decision that said that South Dakota can tax non-resident firms selling services to residents, even if they don't have a physical presence or a nexus. So it might be true that there's no U.S. federal VAT and there's no U.S. federal digital services tax, but it's definitely not the case that you can go to the U.S. and escape both of those. You can't, because it depends on the state. So when you come at it from that perspective, it's kind of a mixed message from the U.S. On the one hand, the federal government is very resistant, especially under Trump, but those investigations of foreign digital services taxes have continued under the current administration. So on the one hand, you have the federal government saying no to digital services taxes by other countries. And on the other hand, you have individual states absolutely passing digital services taxes and expanding their withholding of state sales taxes on non-resident firms, including it would necessarily include foreign firms from other countries, not just other states. So I think it's a mixed message. Now, that's not to say that I expect the US to cooperate with Canada on a digital services tax. They're very clear that they have not wanted to do that. And you have the US having two investigations, one of France and then a second with, I think there were 20 jurisdictions, including the EU as a whole. And the U.S. is threatening tariffs, and those threats continue today. They're sort of in a spot, though, aren't they? Because now the U.S. has said they want a global minimum tax, which is one of the two pillars the OECD is working on. And they want other countries to agree to that, but they are also have put a specific deadline on that tariffs. What they call counter or retaliatory tariffs. I think that they're not retaliatory, but that's because I think that the 301 investigation is not actually the right process by which the U.S. should be negotiating with other countries about those digital services taxes. But nevertheless, if the U.S. is on one hand saying they want the world to adopt Pillar 2 and they want a global minimum tax and they want the OECD countries and the inclusive framework countries to agree to that, and on the other hand is still holding open the tariffs, which are the temporary measure for while countries wait for agreement on Pillar 1, I think the U.S. is going to find itself in an odd position within about 6 months, when either they have to extend those tariffs out another 6 months, like give countries another 6 months, or they're going to be doing two contradictory things, explicitly not cooperating on Pillar 1 while, explicitly requesting cooperation on their view of what Pillar 2 should look like. So it's a tough spot for the U.S. I think that it's hard for tax people sometimes to know what all the rules are in the U.S. because there's both the federal and the state, but then there's also tax and trade and investment treaties and all of these other instruments that matter. So we'll have to see what happens. But I think we're still in a place where we have to wait a little while, see what the progress is at the OECD and in the inclusive framework.
Okay. Another question about this item of investing and digital economy. In Canada, is there any state or where the investors, foreign investors, can use like Silicon Valley or something like that with similar tax protection or legal protection in general, in order to create a startup online and from Canada hub sells digital service to another country? Specifically because in Latin America, well, Peru and other countries have DTT with Canada, and maybe it's a good option right now for our investors. What do you say about that?
Yeah, I mean, I think you really have to talk to an advisor to get a sense of what your specific industry would look like, because Canada has all kinds of interesting regimes at the federal level, but each province and territory also could have its own specific regimes. And in that sense, you know, it's not clear that it's always going to be the same answer depending on where you set yourself up in one of the provinces or across the country or as a federal company. You know, you could have different kinds of things happening. But so there's a federal level tax, which a tax regime that would apply across the board. But then there's differences amongst the provinces. And some provinces have a slightly lower corporate tax rate than others. And maybe they have different kinds of incentives. For example, Quebec is very strongly interested in the film industry and has a lot of film tax credits that Canada doesn't have. And Canada used to have what they called a golden visa or investment residence by investment program. Canada abandoned that, but Quebec hung on to it. So it depends on kind of where you're going to set up and in what area, and there could be some variation. So in that sense, you just have to find yourself a good Canadian tax lawyer and lay out your facts and circumstances and talk through the kind of options that might be available to you. There's no one-stop shop, I'm afraid.
Great. Allison, just in case because Canada signed the MLI, as a lot of countries in Latin America, even Peru, in some countries, because the nature of this ETS is not clear, according to your previous word, the question is how it worked, the arbitration provision between the governments if they don't agree about the nature, about the rate, or if you apply Pillar 2, for example, Peruvian SUNAT or CRA Canadian could say, hold on, okay, we will apply DTT between Peru and Canada, but from my perspective, there is no economic substance because your IT people live in Chile or live in Venezuela, in Isla Margarita, because in Isla Margarita, the capital human are very cheapest than the other place in Latin America. From the dollar, if you compare the dollar with the local currency. So,
right.
Or, okay, IT developer in another country, management in another country, but the owner are the residents in Peru. And Pillar 2 talk about that, the substance, the aggregate value. What is in expect from the investing perspective in the for the future?
Yeah. It's a good question. I actually think we have a lot of uncertainty right now because, well, I'm sure you know the G7, has too much fanfare announced its support for a 15% global minimum tax, but on what, right? And the question about what that tax is going to be based on, what tax base is going to be calculated, is not one that's going to be easy to solve. So I think that the G7 maybe, first of all, kind of got ahead of itself a little bit, because it's not up to the G7 if there is a global minimum tax rate. It's not actually up to the G7 what that rate is. It's up to the 139, or maybe it's 140 now, members of the inclusive framework. And who's to say what rate they will agree to? So Canada, being a member of the G7, may be perfectly fine with a 15% global minimum tax rate, because of course that's our federal tax rate, and not counting the provincial level of tax. 15% is a fairly low rate. We can be above that, but certainly we wouldn't go below that. So, but the question is on what? So the decision about how to compute the tax base and which country is going to be considered the source country for that tax base, none of that has been decided. And I don't think that's going to be decided very quickly, further to our prior discussion. So if you come to a point where you say, well, Canada and Peru, both in the MLI, both have signed the MLI, we have a treaty together, maybe we've come to agreement in the MLI as to which provisions are covered by the MLI provisions, maybe we have some understanding, we have reached some understanding there. But that doesn't mean there's never any disputes. Of course, there's going to be disputes. And if Peru and Canada decide to do dispute resolution in the MAP provision, then we will never know how they resolve those disputes.
Yes.
Right? We won't know either way, but we certainly won't know if it goes to arbitration.
Yes, a good point, because right now, in these days, I talk a lot of clients that I are trying to make a fintech, this kind of neobancos online, with transactions in all Latin America, and they're trying to establish the residence in Canada, because for us it's the best option in Latin America, in general, because we don't have the PTT with the United States.
Right.
The big question, okay, if Canada is a bank is resident in Canada, but the risk management, the people who analyze the possibility to provide loan to the clients in Latin America is not in Canada. If they are resident in Peru, for example, what happened with that? Where is the aggregated value for the Pillar 2?
Right. Yeah, exactly. I mean, exactly. So you pointed out exactly the problem, that the Pillar 2, the a minimum global tax rate, none of that resolves these important questions. For example, where's the beneficial ownership of, various assets or entities? Where are people actually resident? Those are usually facts and circumstances questions. In Canada, they're facts and circumstances questions. The treaty might or might not resolve dual residence. There's a limitation on benefits provision that has to be consulted. All of this detail is not covered in a headline about the G7 agreeing to, a 15% rate, or any rate is not covered. And so none of those problems really are solved yet, I think. And I'm not sure that we should expect them to be solved anytime soon.
Okay. The last question, Allison, from your perspective, how it worked, the arbitration, the process, who decide these kind of matters? This litigation could be between the tax authorities, the contributors are part of the process, or not involved. What do you see, or what do you know about these topics?
Well, it's a great question. And I wrote an article called How Nations Share not too long ago. And I explained it all there. So I will recommend that to your viewers. And in that, I show that the way that we resolve disputes amongst countries is through the competent authority process is actually kind of an interesting and complicated and in some ways troubling process. So what we see is that the treaty resolution process is a country to country resolution, not an investor state resolution. But the taxpayer, the contributor, as you call them, they obviously have an interest in having their dispute resolved. And and sometimes countries don't come to that resolution, and the taxpayer could sit around for a long time. And that's when you start seeing people talking about arbitration and wanting arbitration. But the arbitration is between two taxing authorities, and that's its own kind of an interesting process. In the paper, I explain that the arbitration can have a lot of different forms. We know that baseball arbitration is the one that's mostly favored or mostly used, but it's not the only one that has to be used. It depends on the terms of the treaty. And there's all kinds of different difficulties with it. But one of the things that's for sure about arbitration is that the entire process in tax is confidential. The arbitration outcome and the outcome of competent authority proceedings indeed is just sort of like a closing agreement, like an agreement you would have with your own tax authority. That's not something that's going to be made public. But that means that we can't really learn about how it is that states work these things out. We won't know. So whether and how this changes going forward is really, I think we're in a time of uncertainty about those questions. But the process of arbitration in tax is really more like an administrative agency process, where the taxpayer has a dispute with the tax authority. They work out some sort of a deal, but that deal doesn't become public. It's not a litigation. There's not some sort of discovery where people can sort of see what's going on and where a judge would explain their reasons. None of that stuff happens in tax. Instead, it's more like the tax authorities come to a conclusion, and if they agree to it, then that's the outcome, and the taxpayer still can take it or leave it. But if they leave it, it's not like they have a whole lot of other options. They would be right back in the same situation as they were before the arbitration, and that is dealing with the taxing authority directly. So I'm not sure it really solves anything, but you can read my article and see more about what I think about that topic.
Yeah, sounds very good. It could be very funny in the future. Our future tax litigation.
Yeah, exactly.
Okay, Allison, so thank you for the time, for your ideas, and talking about Canada. See you soon in July with your classes in our Global MBA Tax Management and Compliance.
I look forward to it. It was fun talking to you. Take care.
Same.